Good morning, students, and good morning, Samu. How are you guys this lovely Friday morning? Guys, the meeting is being recorded. Then it's not like we are going to repeat the theory questions, but we are going to apply the theory to the practical part of it, of which we need to understand, guys, that it is very important to know what you are doing. It is very important to know what is expected of you. That's why most of the time, when you look at the questions, please first read at the required part of it. Because once you have that required part of it in your mind, you'll be able, when you go to the question, then you'll be able to understand and to know that, you know what, this particular transaction belongs to this side. Our issue as tax lecturers, maybe it's not only tax lecturer, even accounting, is the framework, the structure on how to calculate an individual's taxable income. That is very important, and most of you guys missed it. And once you miss the structure, then you'll go wrong. That's why it's very important when even you see the financial statement of a company, it has structure. You cannot start with expenditure and end up with sales or income. No, it's not the way that it should be. That's why there is a structure that need to be followed when you calculate tax calculations. For example, and I know you've done that before, when we started this topic at the beginning of the year, the framework on how to calculate an individual taxable income or tax liability, because these are two different definitions. These are two different concepts. When you talk about taxable income, it means that is an income that is subject to be taxed. And the framework will be your gross income, your less any expenditure. Then you come to your taxable income. However, if they are asking for tax payable or tax liability, it means you need to continue with your calculation. Your taxable income, you go and consult your individual tax table where you are going to see how much is the tax rate on that particular income. After you've identified that, then you come to the deduction, the rebates, the primary, the medical. If there's any medical, then you need to take that into account before you come to the tax payable or the tax liability. Please, guys, don't confuse the two, because test one, we've seen it. Some of you got it wrong because you didn't follow the correct structure, even though your answers are right, but the structure is not followed. I'm going to take you through again, guys, this structure. In the form of this example, you'll see how it links so nice. And the structure, you need to know, guys, how to calculate an individual taxable income. Look at this first question, because we've got about 3 questions: the retirement, the partnership, and an individual who is married in community of property. And I can look at the age of an individual, because this will determine your rebates. We have seen test number 1. An individual is less than 65 years of age, but students continue to apply secondary rebate. Where did you get that from? Because an age of an individual will determine which rebate is that particular individual is entitled to. We need to be very careful, students. This is Jane, 40 years old, and she's married to Daniel, who is 43 years old. Look at this, in community of property, because this has an effect on some of their passive income. Daniel has been working for SARS for the past 9 years, and Jane has been working as a manager at Mahonia for the past 10 years. They have a daughter named Lydia, who is 13 years old, and a son named Paprika, who is 17 years old. Jane and Daniel are South African residents for tax purposes. This is what has been given to us, a scenario of the income and expenditure for the year of assessment 2024. We have got the monthly salary for both, non-pensionable bonus, uniform allowance per annum, dividends, foreign interest, South African interest, the bursary, rental income, annuity, retirement annuity, and again, the medical aid scheme, a monthly contribution. And students, when you look at this, already you've got this in mind. How are you going to structure your solution according to the framework? Then, on top of this, there is the notes attached to the income and expenditure. It says Jane is required to wear a uniform at work. The uniform is distinguishable from ordinary clothing. Look at this. It says it's distinguishable. It means she is entitled to that exemption. But if they are saying the uniform is not distinguishable, it means it must form part of your gross income. Can you see the wording, guys? You need to be very careful, be focused on the question, and make sure you understand the notes to the questions. Then again, it says this amount represents the dividend declared by the company, of which Jane and Daniel each hold 7% of the equity shares in the South African company. Jane donated a UK interest investment to his son Paprika, and the amount of interest of 15,000. Jane again, look at this, received a bursary to the value of 30,000 from the company she worked for to continue her accounting degree on a part-time basis. Jane signed an agreement that states if she does not complete the accounting degree, Jane must pay back the 30,000 to Mahonia. Look at this. Even in fringe benefit, we did touch on this particular transaction. Daniel donated a block of flats to Lydia, of which received a rental income of 4,500 per month during the year of assessment. The repairs to the property is 8,500. Jane purchased an annuity. We have spoke about annuity. What is an annuity? An annual payment, an annual fixed payment. Because the word annuity, it comes from the word annual payment. That's why this payment must be received in monthly installment at a fixed amount. If she has to receive 5,000 a month, it will be 5,000 for the whole 12 years. That's why we call it annuity. Jane received her first annuity on the 31st of August 2023, is currently, which is form part of the 2024 tax year of assessment. This was the medical expenditure which she covers the entire family. Other medical expenditure incurred by the family paid by Jane during the year is 15,500 for a specialized entry for Lydia. 6,000 was recovered for the medical aid. 400,000 for prescription medication for Paprika. Then the question is calculate the normal. Look at this, calculate the normal tax payable. It means after you've calculated your taxable income, you continue with your calculations where you need to consult your individual tax table because we want to know at the end of 2024 how much Jane is going to pay SARS. That's what we want to know. Then the best way to approach these kind of questions, look at this. Salary, because we are starting with gross income. Whatever we include in this income, they form part of section 1, definition of gross income, which specifically states that amount received or accrued to an individual either is a worldwide or you are receiving that from the local country or as a resident, it must be included in an individual gross income. And we are told that This Jane received 35,000 because they are saying calculate the Jane, not Daniel. And you can do this on your own, whereby you calculate only part of the Daniel tax liability. You can do that because once we know how to calculate Jane, and you can be able to calculate the Daniel part of it. Then we agree that it's 35,000 times 12 months, and we are told that there's a non-pensionable bonus, 6,000. Yes, it's part of our gross income. The uniform allowance, yes, remember what I've said, because it says that uniform can be distinguishable from others. That's why there's an exemption. However, if that sentence, that clause is not included to say this clothes or uniform does not distinguish Jane, then that amount is not subject to be exempted. It must be from part of your gross income. The South African dividends, I'm always, all the time, tell the students, please don't cram. You must know the reasoning behind why South African dividends is exempted in full. It's exempted in full because when first is paid to the recipient, already the company has withhold 25% of that. When it is paid to an individual, already the tax has been taken from that amount. That's why now it cannot be taxed twice, because it's already been taxed before it can be paid to an individual. That's why we can boldly say that South African dividends are exempt in full. Look at this. These are passive income. That's why I said you must be very careful with the question, because it's in community of property. Then if it's in community of property, then we are going to add, because this one, there is one, there are merit, isn't it? 18,000 from Jane, 20,000 from Daniel, you divide by 2, then it's what we are getting, 19,000. And because we know that South African dividends are exempt in full, we again exempt that amount. And I've seen some of the students, they start with the income and there's a separate line for exemption. They list all those exemptions. Is okay. It's right, again, if you do that. But it's easy for marking purposes when you put it like this, because you just once, okay, this uniform allowance, this is an exemption, this dividend, this is an exemption, this foreign interest, then we know it makes marking to be easier. Then the dividends, the foreign interest is 15,000 divided by 2. Let me just go back to the question, because there is a foreign dividends. Oh, South African dividends, yeah, okay. No, South African dividends, yes. Foreign interest, 15,000 divided by 2, because it was received by Jane, 7.5. However, 14,700 plus 22,000, that is South African. We divide by 2, of which is 18,350. Remember, there's an exemption for South Africans, of which is limited is 23,800. It cannot be, yes, supposed to be 23,800. That is the limitation for an individual who is less than 65 years of age. That's why I'm saying the age of an individual, it plays a major role. Not only on the interest, again on the rebates, you will see. Because this particular individual is entitled to primary rebates, and we know that our primary rebate is 17,235, but most of you guys miss it all. Let's continue to see. The bursary is 30,000. Exemption is 30,000. Let's look what they're saying about the bursary. Because there is a clause in that bursary to say, if Jane signed an agreement that state if she does not complete the account, Jane must pay it back. And again, look at the amount, the salary that is earning. Look at the salary, 420. But if it is more than 600,000, then it's another story. That's why you need to make sure that you check every transaction. But there is 30,000 exemption because it's less than 600,000. Rental income is passive. That it does not form part of your remuneration. That's why, guys, it's very important when we are going to do retirement. Part of this rental income that do not form part of remuneration. That's why we don't take them into account. But in this, because it's individual calculation, tax payable, here is not a retirement. You will see when we do retirement, the differences. Here, rental income, they have received 4,500 per year. But because they are merit community of property, that's why we divide by 2, then it's 27,000. This about is 2 marks for this. 2 marks for divided by 2 South African interest. It's a lot of marks at stake. Annuity received. Yes, we are told that annuity was received of 5,000. Jane received, she will receive 5,000 per month for the next 12 years. 5,000, but for 7 months. Because it is stated. Where's that transaction? They say Jane received the first annuity payment on 31st. Then when you count, then it will be 7 months annuity receipt. It's 35,000. And this exemption, of which most of the students, they find it very difficult to calculate this. I don't know why, but if you find it very difficult, please go and revisit this type of exemption and have a look. I'll go back and refer to show you the questions. Because they're saying Jane purchased an annuity for 600,000. The whole information is there, guys. Our A is 600,000, and B, because they received 5,000 per month for 12 years, and it's for 5 years, 5,000 for 12 years is 12 months and 12 for 12 years. Because we are doing for 2024 tax year, of which starts from the 1st of March 2023 until 29th of February 2024. It's 12 months for 12 years. Then our annuity received is what we have calculated above. We have calculated, look at this, we have calculated this. 35,000, this is 35,000. This marks for this. And when you calculate the whole calculations, A over B times C, and put these figures, you will see you will get this 29,000, 167,000. Then our income, you add minus exemption, you get 520.33. Guys, someone is like want to talk. Any questions, guys, on the income part of it? Too dressy, but on the income, yes, Gugu. Gugu. Let me just try this. Where's Gugu? People. Gugu, can you talk? Okay, let me just do this. Yes, Gugu, I've allowed you to speak. Oh, Gugu, mute yourself. Let's continue. Oh, let me just check the chart. Okay. Guys, you can again use the chart for your questions. Let's continue. We are happy with the incomes. So now we need to go to our expenditure, the expenses, because the purpose of this is to answer the required part of it, to say calculate the normal tax payable. Then the rental property deductions, yes, there was the deductions because the income was divided between the two. Even the deductions, they must be divided between the two of them, of which rental deductions was 8.5 divided by 2. It means each one will share a portion equally. Then this is our subtotal after deducting our expenditure. Yes, again, there is section 11F, retirement fund contributions. Guys, most of you, you don't know what you're doing when we come to this. I'm going to explain it nicely. You know what? Just nicely to you. They're saying there's a contribution of 8,500. Let's look at that particular transaction. Let me just look at it. Oh, I'm sure it must be here. Yes, retirement annuity fund contribution for the 8,500. So we are happy with that contribution. However, it is limited to the lesser of the following: 350,000 or 27.5 of the higher of. Guys, this is a principal mark, but most of you did not manage to get it. You cannot say 350,000 of remuneration plus 420, what you calculate. You must say 350,000 or 27.5% of the higher of the following. Remuneration. Yes, we have got bonus. Look at this. We are only taking the remuneration into account, and again the exemptions. Look at this. We've got remuneration of 420,000. We have got uniform allowance minus exemption. We have got again bursary of 30,000 less exemption, and again we have got rental. Is it rental? Annuity received, yes, of 35,000 minus 35 exemption, which is 420,000 multiplied by 27.5%. The purpose of this, remember, we want to know which one is the lesser between 8.5, our contribution, and the limitation of 350 or 27.5% of this, of which is 115,500. And again, they say taxable income before donation. We have got our taxable income subtotal of 516,000 multiplied by 27.5%. Look at this. The amount is 141,923. And taxable income before donation and capital gains 5106.03. Let's see the lesser between the two. Look at this. 350,000, 115,500, 141. The lesser is 141 and 350,000. And taxable income before donations, capital gains. So because the contribution that was made is lesser than our calculations of remuneration, and again, the taxable income before donations, then therefore the full amount of 38,500 is deductible. Let me see, there is a question, say, for annuity in remuneration, why don't you subtract 29,116 and use 35,000? I don't know what to say, but I will explain it to you. Remember, the amount that was paid is 35,000, not 29,000. Let me just see. Let's go to the calculations. Because it's 29, 291. Why don't you subtract 291,667? I don't think it's 291,000. I don't think it's 29,000. Let me just see. It's 29,000. So then, Lele, look at this. No, it's fine, Lele. I understand what you want to say. No, it's fine. Look at this, Lele. How much did you get in your pocket, in your bank account? Did you receive 29,000? That is an exemption towards that. But what is the receipt? Remember, gross income definition, Lele, it says amount received. How much did you receive? 35,000. Then we need to deduct the whole 35,000. Where's Lele? Let us go and check Lele again. Lele? All right. Thank you, Lele. Let's continue. Remember, Lele, whatever you are doing, remember, whatever you received, that is the amount that you've received in your bank account. This amount that you've received. So you cannot say I've received 5,000, but I'm deducting or I'm declaring 3,000, of which we are looking at the amount received. What's that? Let me just go back. Surprise? Do you have something to say? Surprise? Surprise? Okay, no, thanks, Surprise. Let's continue. I promise you, after this, we're going to get about 5 minutes a stretch break. Let's continue quickly, guys. Then, look at this, because they are saying, calculate the normal tax payable. For you to do that, you need to, there's no way that you cannot use your tax table. There's no way, because they are saying, calculate the normal tax payable. Look at this. If they were saying in the required part, calculate the taxable income, then it will be done by concluding this. Okay. Undo. You'll be done on this one. If the question was saying calculate the taxable income, it means you'll be done on this one. But it says calculate the normal tax payable. It means you need to calculate further, because this taxable income is subject to be taxed. And how do we tax it? We are going to tax it using individual tax table. And we agree that our taxable income is 507,583. Let's look at our tax table just to confirm. It's 503, 507, 583, of which it falls. It's 507. It falls under this category. Can you see, guys? It falls under this category, 507. Oh, this color doesn't look nice. Which one is nicer? Yo. Let me try this one. Yes, it says exceed 370,500, but does not exceed 512,800. But we know that our taxable income is within this category. It is 507, 583. Then we are going to take 507 minus 370, because it does not exceed 512. It doesn't exceed 512,800. It doesn't. That's why we say 507 minus 370. Then multiply by 36. Why 36? Because yes, we are told that under this category, no, it's not 37, it's 36. 31%, yes. Let's go. Why is 36 here? 507, let's double check. 507 is here. It's 3177. Let me see, 773. Oh, yes, right. It must be 31, guys. Work with me. Yes. That's the correct way to do it. I will change the solution, guys, and send you, when I put solution on your link, on Moodle, let me just write something to say so that I will know. No comment. change the tax rate to be 31%, not 36%. Yes. When I send you the solution, it must be 31%, not 36. Then let's primary rebate. Look at this, guys. That's why I was saying it is very important to know the age of the years of an individual. My PowerPoint slide, guys. Some my computer is jammed, so I'm going to switch it off and come back again. Just let the student not to go. Okay, I told the students, but I think they can hear you as well. Oh, they can hear me. All right, guys, don't. Oh, guys, all right, guys, don't go. I'm going to log out and come in because it's just started. Don't go. Let me just do it quickly. Thanks, guys, for being patient. I'm back again. Let's continue. Oh, Nompumelelo. Oh, no, oh, okay, we can continue. Nompumelelo says it was a mistake. Okay, let's continue, guys, quickly. Let me just, yes. I want to increase this. Okay. Can you see, guys? Can you see my screen? Just type in the box. Oh, thank you, guys. Yes, we were here. Lisa, before we continue, Lisa. Yes, your friends have put your hand, Lisa. Question, please. Let me just try to. Lisa, let me just allow Mike. Yes, Lisa. Lisa. Okay. Lisa is quiet. Let's continue. Less primary rebate because now we've calculated what is this tax rate on the taxable income. We said it's 126 according to the slide, but it's subject to be changed when I do the correct changes. Less primary rebate. Yes, we know that an individual in South Africa who is less than 65 years of age, that person is entitled to a primary rebate of 17,235. It was going to be different if an individual is more than 65 years, then we'll consider secondary rebate. But at this point in time, we are dealing with an individual who is less than 65 years of age. That's why we are correct to say the primary rebate is 17,235. I was so shocked, guys, when I see the students. They don't, I'm sure they've heard about 17, but the rest of the figures, they didn't know the exact amount of primary rebate. Guys, is 17,235. Then there is a medical contribution. And where there is a medical contribution, guys, we need to calculate 6B. But in this case, there's section 6A, medical credits, and section 6B. Remember, 6B is out of pocket. Then 6A, because they said the individual does belong to the medical aid. And let's go and see the correct weighting of this particular individual. They say Jane is the main member of the medical aid and covers the entire family, of which, look at the families, is the husband, is the daughter, and the son. Then there are two 728 is Jane and Daniel, another dependent, the daughter, and the son. And it's for a period of 12 months. Can you see, guys? 14,640. And because it's a deductions, that's why we put it in brackets, or there's a minus sign before. And 6B, there's the contribution. 43,200. Where did we get this amount from? How do you calculate this amount, guys? In the chat box, let me know, because I'm interested to know, where did we get this amount? Guys, Jenny's contribution is 3,600, of which is 3,600 multiplied by 12, because it is for a full year. Therefore, it's 43,200. I can even type it. Contribution in the chat box. Contribution by Jane is 3,600. Then it will be 3,600 multiplied by 12. Then it's equals to 43,200. Then less 4 times section 6A, because we have calculated 6A as 14,640 above. Then my question to you guys, you need to answer me, guys. Why are we using 4 and we are not using 3? It says less 4 times section 6 cap A, and section 6 cap A we have already calculated as 14,640. Why are we using 4 instead of 3? Because some can use 3, of which I've seen it in the first test. What informs you to use 3 or 4? Let me just write in the chat box. What informs the student to write 4 instead of 3? Oh my goodness. Skulekile, how disability and age. Oh my goodness. Sibanda. Skulekile, Sibanda. How Skulekile, please go and revise, do a revision. Guys, there's any disability here? Let me check. Madiba said disability. I've never come across that. Let me see. There's a name. Guys, the age of that individual, and there's no disability. When I Skulekile and the other guys, where did you get disability from? Maybe there is, I don't know. Where did you find disability? No, it's another topic for another day. The age, we're using 4 because then individuals less than 65 years of age. Sometimes maybe my eyes see something that you guys don't see. Maybe you see something different than me. Okay. Let's continue, guys. Other qualifying medical expenditure. Guys, why they say other qualifying medical expenditure? Because there are the ones or others which are not qualified. Remember, when they are saying qualified, it means those are prescription from the doctor. Then if that is a prescription, then you are entitled to claim that particular medical expenditure. Can you see? Specialized dentistry, it means the doctor has referred you to a specialized person or a doctor. Prescription, it comes directly from the doctor, a professional and an expert. That's why those kind of qualifying or as qualifying medical expenditure. Let's say there was one maybe over the counter, medications over the counter. No, that is not a prescription. Therefore, you are not entitled to claim that particular over the counter medication. Then again, they say less 7.5% of your taxable income. We know our taxable income. We've calculated our taxable income. Then again, guys, why 7.5%, not 33.3%? Because they're the one other students who use 33.3%. Why, guys? Why are we concentrating on 7.5%, not on 33.3%? Because one can, do that. But there's something that informs us not to use 33.3%. Why, guys, are we using 7.5%? The solution will be or the answer will be the same as why are we using 4.3? ISN, you cannot say individual. This is not an answer. Individual, no, that is not an answer. Please dig deeper in your pocket, SN. It's not. Then, can you see? Because there's a minus figure times 25%, of which it is 0. But remember, the reason why you get a principal mark is because you are able to identify which percentage need to be used. Then now we answer the question, tax payable by Jane. Can you see? Because they were asking us calculate the normal tax payable. Then we did that 100%. Guys, I was so excited, and I'm still in that mood of excitement because we have got about 6-7 students who got 100% in test one. 100%. One got 99%, it's almost 100%. I'm in that mood of celebration. We are going somewhere. Guys, please pull up your socks. Because when you look at the difference between someone who gets 100%, somebody who gets 28% or 14%, that is a disaster. It means someone needs to pull his or her socks. Are we together, guys? Atlagan, Skulekile, and the others. Are we together, guys? Guys, can I suggest we get about 5%, 5 minutes, not 5%, 5 minutes break, just 5 minutes break, then we'll continue with the rest. We'll be done in no time. Are you in agreement, guys, to take 5 minutes break just to stretch our legs? Okay. Samu, are you comfortable, my sister, to take 5 minutes break? Then we'll come back at around 25 past 12.
Yes, sir, that's fine with me.
Okay, guys, don't go forever. Come back 25 past 12. We are starting. Exactly. Thanks, guys. See you in the next 5 minutes. Welcome back, students. We are continuing with another questions of which is retirement benefits. What is it anyway? You know, before I answer a question, I need to know whether I do understand what is it anyway. What is retirement benefits? Because this explains itself. Retirement. When you retire, you'll get your pension, your provident fund. If there's any benefits that you are entitled to, then you will get those back all upon your retirement. That's why they are called retirement benefits. And if there are retirement benefits that are subject to be taxed at a different rates as compared to, those individuals that are still active in working. Those are still working, because those who are still working, then there's individual tax table. But retirement benefits, it has its own table, because in fact, we need to use our common sense here. Because when you are retired, I don't think the tax will be the same as the person who's still active in his or her working place. Because retirement, it means you are getting that amount, you are not going to get anything afterwards. Therefore, the tax cannot be that much, because you have already contributed a lot to the South African government. I'm saying even the tax authorities, because you'll be taxed every now and then when you are still active, you'll be taxed all the way. So now is the time to enjoy the labor of the fruit of your labor. That's why when you are retired, you are entitled to receive, the old age pension fund, or old age, they call it, I don't know, SAS or something, but you go there, you get that a monthly amount. And that amount, remember, you've worked for it. Then look at this question and just relate. You must be this person of, or to relate with something. When you read something, just relate with the scenario around you, because this is tax, a social thing. We are living tax, we are eating tax. Then it says, Miss Elliot, a 59-year-old South African, worked for a design and fashion company. She decided to retire during the 2024 year of assessment, with her last working day being the 30th of November 2023. For the 2024 year of assessment, she received the following amounts. She earned a salary of 45,000 per month. She received a lump sum payment from her employer of 250,000 upon retirement. This is additional information. She retired from a pension fund on the 30th of November 2023 and received a lump sum of 1,500,000. Previous contribution not allowed as a deduction as at 28 February 2023 amounted to 25,000. A current contribution to the pension fund for the 2024 year of assessment amounted to 4,500 per month. Ms. Elliot started receiving a monthly annuity from the pension fund of 25,000 at the end of each month from the 31st of December. Look at this, the annuity from the 31st. It means it's January, February, to the end of the financial year end. Calculate the total tax due or the total tax liability of Ms. Elliot. Look at this. Salary 45,000 multiplied by 9. It's 9 months, because they say her last day was on the 30th of November. From March to November, it's 9 months, because November we must take it into account because it is for a full month. We take that into account, 405,000. Pension annuity, 25,000. It's for 3 months, because she started to receive December, let's say, just to be 100% sure. Look at this. Miss Elliot started receiving a monthly annuity from a pension fund at the end of each month from December. December, she got something. Can you see? January, she got something. February, she got something. That's why we are saying 25,000 multiplied by 3, because she received by the end of December. She received the end of January. She received the end of February. That's 3 months. An exemption. Section 10C exemption. Students, let me just give you this, a friendly advice. When you look at exemption, go to section 10 of the Income Tax Act. It will show all the exemption, because section 10 of the Act deals with only exemption. You need to know what is exempted, what is not exempted. That's why they've mentioned section 10C exemption. This is the term of reference. So why are we exempting that annuity? Lump sum from the employer, we are told, is 250,000. And the most important part, look at this. We have got about 3 columns, one for description, one for the lump sum, one of the normal tax. And I've seen it, students, please don't make this mistake. If there's any lump sum, you read a column. Otherwise, you're going to confuse the two and you're going to get it right, because it's not a normal tax. Salary is subject to a normal tax where you use your individual tax table, but lump sum, there is another tax table. That's why you need to separate the two. Most of the time, we get it wrong because we don't separate these two. You cannot put 250,000 and 1,500,000 into the column of normal tax. No. These lump sums, they are not subject to be taxed at normal tax rate. However, they've got their own tax table. That's why we need to divide to put lump sums separately from the normal tax amount. Less previous contribution or deduction is 25,000, of which is limited to 25,000, then it's 0. Look at this. The total. Oh, what did I do? Yes, this way, yeah. Then the total pay each, and the lump sum is 1,750,000, and the normal tax is 455,000. However, Miss Elliott contributed to retirement annuity fund and pension fund contribution, of which, remember, we said she worked until November, of which is 9 months, 4,500 to which she contributed, multiplied by 9, which is 40,500. Then again, we are doing the same calculation for RAF contribution. Is 350,000 or 27.5% of the higher of the following. Guys, if you can ask me these rules, even in the middle of the night, I will tell you how the rules works. So if I can, and you can tell me, because these are not difficult rules. They are telling you for you to calculate section 11F. This is what you need to take into account. The contribution. However, that contribution must be limited to the less of the following. They give you guidance, because if the contribution is more than these calculations, then you need to ignore the contribution and takes whichever is the lesser between the remuneration, the taxable income before donations. Because the main purpose of doing these calculations is to determine which one is the lesser between these two. Look, remuneration is 405 plus 75,000 of annuity, less exemption, multiplied by 27.5%, of which is a principal mark. Because you can identify which amounts form part of your remuneration. That is what we want from you. Identify which amounts form part of remuneration. That's why they say the first option is the remuneration. what consists of remuneration in your calculations. Yes, we have stated them, and multiply by 27.5%. That's 125, 125. Taxable income before donation, 455, because it's the same amount, 405 plus 75 minus 25, it will give you 455. Then it means, look at this, taxable income before taxable gain is 455. So what we have calculated above. Therefore, the lesser between 350,000 and 455 is 125,125 rands. But it must be limited to the actual amount of 40,500, because this is what we have contributed. Then taxable income is 404,500. And again, look at this. Tax per table. 414,500 minus 370. I still remember this. Yes, it's correct. We put 31%, not 36, because it does fall under this category, 31%. Plus 77,362, then you arrive at 91,002. You can verify on your side, guys. And if you don't believe me, let's go back. Our taxable income is 404,500. Let's go to our table, 414,500. 414,500. 414 is this. Can you see? 31%. 77,362. Then it means we are correct. Then primary rebate, yes, this one, 17,235. Normal tax, 73,767. That is on normal tax, but on lump sum, because our lump sum amount is 1,750,000. Let's go and look at our lump sum quickly. Where's the lump sum? Let me just quickly check the lump sum. It must be here. The lump sum. Look at this. The lump sum. Retirement. It's not withdrawal, it's retirement. It's 1,750,000, which belongs to this category. 1 million minus 770,000 multiplied by 27% plus 39. Let's see if our calculations are all right. 1,750,000 is 1,750,000 minus 115 times 36. Look at this. Guys, just a minute. Look at this lump sum amount. It's 1,750,000. 1,750,000. Where am I going? 1,750,000. 1,750,000. Can you see? It's the last one, because it does exceed 1,155,000. That's why it's 1,750,000 minus 1,155,000 multiplied by 36% plus 143,550. Yes, we are correct in doing that. We are 100% correct. 100% correct. Then under lump sum, Miss Elliot is paying 357,750. Under normal tax, she's paying 73,000. The total tax payable for that year is 431,570. Then, oh, we are done with this one. Then the last one is partnership. I mean, 30 years old and John, 33 years old, carry on a small business in partnership. Because the partnership, when you are in a partnership, individuals are taxed separately according to their profit sharing ratio. Whatever you come into the partnership, whatever capital you are contributing into the partnership, it will determine the profit sharing ratio. Let me give an example. This Mr. Masela and Mrs. Masela. We are opening up a small business. I come with 60,000. She comes with 40,000. Can you see that our profit sharing ratio will not be the same? Mine would be 60%. Hers will be 40% because it's out of 100. If we come with 50,000, 50,000, then that is equal. Then whatever income we generate, we must share it equally. Whatever expenditure we gain, again, we must do it equally. Look at this. And how to do that? You need to first calculate the income of a partnership, the profit and loss account for a partnership. Then after that, you need to distribute. If there's any income, it must be divided according to the profit sharing ratio. If there's any losses, again, it must be shared amongst the two using the profit sharing ratio. This is the net profit of the company, the salaries, the fuel, the pamphlet, advertising, wages, water and electricity. Let's see. Interest paid on capital account. They've got these investments of which it earns an interest. The interest earned by a partnership, this amount. And again, donations amounting to 2,800 to a children's home. The children's home is a public benefit organization, and a receipt was received. Then we know if a receipt was received, this section 18A certificate, that is a proof that a donation has been made. Bad debts, I may belong to a medical aid and contribute 18,000 for the year. Ami's husband and their daughter are dependents on the medical aid. Ami paid 2,800 for doctor's consultation fees and 1,000 for over-the-counter medication. Can you see over-the-counter medical contributions? Calculate Amy and John's tax liability for the year ended. Net profit, yes. Salaries, yes. Interest paid, guys, these are given. Interest earned by partnership, transfer. When you transfer, a transfer does not have any tax implication because it's a transfer from one bank to another. It does not have any tax implication. Water and electricity, yes, 75,000. Wages, yes. Advertising cost, yes. Fuel cost, yes. Retirement annuity fund paid by Noah, yes, it is given. But transfer to partners, no, it cannot be. It cannot have any tax implications because it was first taxed in the partnership. Therefore, on individual say transfer, it cannot be taxed twice. Therefore, it is not deductible. Donation again transfer, it cannot be. Can you see, guys? This is straightforward transactions. Then because the question is calculate the notional taxable income. Let us see. What was the calculate the and John's tax liability? Yes, it means we need to go further to say their profit share ratio we are given in the question that Amy holds 60% and John 40%. Whatever profit they are making, they must share it according to the profit sharing ratio. The profit for the partnership is 401,000. Then out of 401,050, Amy will receive 60% of that amount, and the rest will go to John. Salary, yes, separately, they've got their own salaries. The interest is 3.5. However, it must be shared between the two because that is an interest on their investment. Then Ami is 3,800, of which they're only limited to 23,800 because they are less than 65 years of age. Retirement annuity fund paid by the company, fringe benefit. Yes, guys, I said a fringe benefit is any contribution, any amount paid by an employer on behalf of an employee. That's a fringe benefit because an employee, you didn't pay anything. However, the employer paid on your behalf. That is a benefit. And fringe benefit are income in nature. That's why they form part of your gross income. You know what? This, tax is linked to one another. When we are busy talking about salary interest, there comes a fringe benefit. And we have learned much about fringe benefit. These are income in nature. These are not cash payments. However, the right of use of an asset, the right of use of a company asset for business purposes. Then we get to the income for both Amy and John. Then deductions. Vendors, they need to remember whatever deductions, they must share equally. Not equally, however, 60%, 40%, according to the profit sharing ratio. Amy contributed to Provident Fund of which 3.8. Then there comes Section 11F, limited to the lesser. You cannot run away from this. You need to know it. Limited to the lesser. Once you say limited to the lesser of, that is a principal mark. 350,000 or 27.5%. You will see in your test one, we gave marks for this. These are easy marks. Remuneration, 240, 180 plus 38. Remember, when they are saying remuneration, you need to know which amounts are included in a remuneration. Interest is not a remuneration. When you are working on a company, they're giving salary, they are not giving interest. Therefore, interest cannot be part of your remuneration. But bonus is part of a remuneration. Because that is linked to your job description. But interest, no. You put some money in an investment account, you get interest. You didn't even work for that. That's why it cannot form part of your remuneration. Then let's see the calculations. 114, 116. Then the taxable income. Therefore, 116 is the limit. Therefore, look at this. After we have done all the calculations, remember, donation was done. And that donation must be split between the two using the profit sharing ratio. This is the taxable income. Tax payable for Army, because we need to calculate both. Army, yes. Same procedure for John. However, look at John, because his profit sharing ratio is 40%. That's why his income is lower than Amy. They are both less than 65 years of age, of which they are entitled to primary rebates. Yes. Then look at this. Only Amy, who contributed to the medical, who belongs to the medical aid. That's why we look at this. 728 plus 246, 11,668. How did we get to 246? How did we get that? Let's go to Amy and see. Amy belonged to a medical aid for the whole year. Amy's husband and the daughter are dependent. That's why there's an additional. That's why, let me just check. Where's medical? That's why it's Amy and her husband, and additional, the daughter, 246. This is for the 2024 tax year, remember. Guys, this changes every year. There are some students who are using the 2023 figures. That is wrong. Medical aid contribution, Amy contributed 18,000. Less 4 times section 6. Oh, let's see now this interesting part. Where's that question? Or is the same as that one we did? I thought this has got something to do with disability. No, there's no disability. and they are not over age 65. Then the same process at qualifying expenditure, of which section 6B, doctor's consultation. Yes, you have consulted the doctor. Over-the-counter medication, not qualifying. As I've said, these are not prescription. That's why you are not entitled to claim this. Less 7.5% of taxable income, then tax payable to SARS. Guys, there is a question. Sorry, Simpiwe, I didn't see that. He said, sir, can you please repeat section 10C exemption of 25,000? Guys, who can explain this in the chat? Before I explain it to Simpiwe, who can do that? Because I know Ms. Sopromani has done this with you. I've even checked the slide. It is there. Who can assist Simpiwe for section 10C exemption of 25,000? Remember, there is a limit. And the limit is because she contributed 25,000, therefore is limited to the actual contribution. That's why it's 25 minus 25, because the contribution was 25,000. Anyone who can share in the chat box, guys, the 25,000, because Simpiwe, you know, she's dying to know why is this 25,000 exemption. Anyone else, guys, in the chat? Or you can raise up your hand, I will unmute you so that you can explain it better. Guys, you cannot tell me out of 50 students that are present in this, they don't know, oh, AM is coming, let me just do justice. Akahang, let me just do justice to you. Akahang, please go on, my sister, the platform is yours. Akahang, allow Mike. Yes, Akahang, go ahead. I'm interested, I'm eager to know. Unmute yourself, Akahang. Unmute yourself. Allow Mike. Yes, I've allowed. Zamu, can you please assist? Because I've enabled her to speak, but I don't know what's happening.
Sir, her mic is allowed. She can just unmute herself and speak.
That's why I'm saying she must unmute herself. Again, there are 3 buttons. Please just click one to unmute yourself. Again, we are left with few minutes. Please unmute yourself. Or just type in the chat. I can't unmute from myself. I will type. Okay. Akang will type. In the meantime, guys, any questions while we are waiting for Akang to type? Any questions, guys? I'll be sending the amended solution for this. Please, please, please go ahead, guys. Make sure you understand the principle. All the principles, and you can see most of our questions, they look similar, but they're not similar. The most important part is to know the principle. Even though the question can come upside down, but you know the principle, and you cannot go wrong if you know the principles. And if you don't know what principles are, for example, we are saying South African dividends is exempt in full. Then the principle is you need to declare that dividends and you need to exempt it. That's the principle. Because it was already been taxed before it can be paid to a recipient. That's why it cannot be taxed twice. It's a principle. Interest. We know that any individual that is less than 65 years of age is entitled to an exemption of 23,800. That is a principle. Annuity, there's an exemption. That is a principle. When you calculate Section 11F, retirement annuity fund, is a principle. You need to first do your calculation to see whichever is the lesser between your calculations and the contribution made by that particular individual. That is a principle. Primary rebates. We know that if an individual is less than 65 years of age, that person is entitled to 17,235. That is a principle. And again, another principle is when you calculate your normal tax payable, sometimes you don't care about whether you get taxable income correct or not. As long as that taxable income, you have used the correct tax rate. That is the principle. And at the end, if they say tax payable, you need to say tax payable. That is a principle because you are answering the question. Tax payable or tax liability. That's a principle. You cannot say taxable income. No. Because we've already calculated the taxable income. It's no longer a taxable income, it's a tax liability because you have taken all the tax rate into account. You have taken all the primary base into account. You have taken all the medical into account. There's no longer a taxable income, it's a tax liability. Those are principle, guys. Guys, are we together? Yes, Atahan. Come again, Atahan. But we are waiting for you to explain in the chat, Atahan. What's happening?
No, it's
Oh,
not
yeah, no.
Atlehang.
Yeah, you are. Thanks, Atai. Go ahead. The stage is
No,
yours.
it's not Atlehang.
Who's this?
It's
AM.
Apiwe. It's not Atlehang.
Oh, sorry, Apiwe. I see Atai Matibe. Oh, sorry, Apiwe. Go ahead, Apiwe.
Yeah. So, so regarding question 1, Bazar. Can you hear me?
I can loud and clear, Apiwe.
Okay, yeah. Bazar,
Yes.
in question 1.
Yes.
There's a question I did when I was preparing for test 1. It was
Yes.
Simba. And then Simba is married in community of property.
Yes.
And then he received a learnership. The learnership was 40,000.
Yes.
And then his annual salary was above 600,000.
Yes.
But there was an exemption there. They exempted 40,000. They said that the reason for the exemption was agreement in place.
Okay, that is very beautiful. Thanks for that. Remember when Apiwe, when you apply for a bursary or
Yes.
it's a learnership, Section 11, it says there is some agreement. There is an agreement to say, even now, maybe if you have got a bursary, they say, if you can pass with this record time, if you don't fail, then we'll continue paying you that bursary. It's an agreement. But if you fail, we take it away from you. That's an agreement. If there is an agreement attached to that, then you need to be obliged by that agreement.
Even if your annual salary for the year
yes. No, even though, remember, if let's say there's an agreement and it's above 600,000, you still exempt. But let's say there was no that agreement, then yes, that will not be exempted if it is more than 600,000. But because there is a clause that says that, I'm sure. Let's agree on one thing, Apiwe. Maybe are you getting a bursary from any company to study?
No, I'm funded by NSFAS.
NSFAS.
Yeah.
No, remember, NSFAS is different between a company bursary, because a company bursary will say after you finished your degree or passing in a record time, you don't fail, then you will come and work with us. That is an agreement,
Yes.
isn't it? And they will say,
Yes.
you need to pass all your modules, not maybe first year, second year. You need to pass those things. Failure to do that, then they're going to take it away from you. Then it means you have to pay out of your pocket.
Oh, okay.
That is
Okay.
different between NAFSAs, because NAFSAs, even though you can fail maybe one module, they can maybe still maybe give you money again to continue. I know about, in my time, it was an TEFSA. I'm not revealing my age, Apiwe. It was TEFSA. TEFSA, even though you fail one module, let's say part A of tax, they can still pay you, pay again, not pay you, but pay for the module for you to complete. It does not depend on whether you fail one module or not. As long as out of 5 modules you've passed 4, then they can still fund you. But a bursary is very strict when you compare to NEFSA. It's very strict because there are some conditions, there are some clauses.
Oh, okay. Yeah, I get it now.
It doesn't matter that you are owing more than 600,000. You are earning that 600, because there is, in normal case, if you are earning more than 600,000, it's too much. That's why there's no exemption. But the exemption is those who earn less than that amount per annum. But in this case, a bursary, it says these are agreement. It's not NEFSAs. Because NEFSAs, they cannot say, if you pass all your module, come and work with us. No, they can't say that. But once you work, then you can make some arrangement to pay that amount back. But with bursary, they will say, come and work 2 years with us. Then after 2 years, you're not owing them anymore. You can go and look for another job, or you can still work with them. But you know that you have got that, what can I call it? I don't want to say proof of evidence that you've already guaranteed. Yes, I want this wait. You are already guaranteed working place in that company in terms of a bursary, already guaranteed. Look at this, and I can my TV. Okay, in the chat I can explain it nicely. Section 10C exemption. Guys, look at that exemption. I'm still with you. I'm sure you've got something to say again. Apiwe.
No, sir, it's fine now. I understand.
All right. Can you see, guys? Ateng, thanks a lot. You've explained it nicely in the chat box. That is the way it is. Guys, look at the Ateng's Matibe explanation. You know, Ateng, no, Ateng, you can be a presenter or a teacher. The way you've put it, that is nice. Are we together? Any questions, guys, before we wrap up? Because we are over the time now. Anything before we leave this session, guys? Any questions? I will only allow one question because we are over the time. Any questions, guys? Samu, can we end up the session?
Yes, so we can end the session.
Okay, guys, but remember, guys, if you've got questions, please, you know our email addresses. Please ask us those questions. Then, guys, thank you and have a fabulous weekend ahead of you. See you when you see me. Thank you and bye. Thank you, guys.